LA fires have caused massive damages, and people are wondering if the insurance is covering for the losses. My guest today is Karl Susman, who's an insurance agent with hundreds of homes that are impacted in the fire area. He's here to tell us how does it work on the ground, getting reimbursement for these homes, and he has some tips for homeowners in California.
If they have a replacement cost policy in California, they have three options. They can use the money to rebuild the home right where it is. They can purchase another home somewhere else, or they can build a house somewhere else, and the mortgage will go on that house as well.
I'm Siama Korami. Welcome to California Insider. Karl, it's great to have you on. Welcome.
Thank you so much. It's great to be here.
You are in a tough spot because we have had major losses. You're an insurance provider. You have a large number of homes in your community that you've been insuring. We want to hear from you what's happening with the insurance companies.
Well, right now there are different types of companies doing different things. You have the primary companies that you've heard of. I call them the name brand companies, and they're calling in extra support. They're calling in adjusters from other states so that they can have a lot of people to help with the claims. And they're getting the money out quickly. It's still scary for me to see it, but I see it every day. They'll EFT transfer directly into somebody's checking account, $2.5 million. I mean,
Wow.
I see these things happening every day. And it still kind of, shakes me a little bit to see these types of dollars that are going out. So the main carriers that people are familiar with that they have, so far, I can honestly say they're getting paid very quickly. The only time that I'm seeing some delays in money going out is with people that are insured with the California Fair Plan. And I think that that's going to change because there's a lot of noise being made that they have to try and step it up a little bit. So I'm hoping that sooner than later, we'll start to see those dollars flowing faster.
And so does the Fair Plan delay the payment, or how does it work?
I don't think it's anything that nefarious. I think it's a matter of organization, is that they just don't have the manpower already locked and loaded and ready to go. They have to bring in resources from other places. They're using non-employees to help. They're getting other people to try and assist them with the process. They just don't have the manpower or the systems to work on something that's quite this large. But I think, again, because there's so much complaining going on, and I can be honest to say we're a part of that. We're making a lot of noise. I talk to the Department of Insurance almost daily with potential problems that we're having and delays. It's just a matter of having enough bodies to do it. You might have one adjuster that has literally hundreds of people that they're supposed to deal with. How many people can you reach in a given day?
And do they have enough money to pay out?
Well, Fair Plan is an interesting organization because they have different buckets of money. They have cash on hand. They have what's called reinsurance, which is insurance they purchased for just this occasion to have more money coming in. They have the ability to call out bonds in California. And then if they still don't have enough money, they're able to assess every admitted insurance company in California. So effectively, they have the financial backing of all of the admitted insurance companies in the state of California, which is a lot of money. It's just a matter of how are they going to get access to those funds and how quickly can they get it.
And then they may end up tapping to the other policyholders too, right? With the new changes in the law, right?
Well, what can happen is if there's over $1 billion that's paid out in an assessment, meaning that the Fair Plan says we need $1 billion, and that's likely, then after the $1 billion, the insurance carrier is allowed to, with the department's permission, and that's a big if, because we know the Department of Insurance is very consumer friendly, so the likelihood of them approving that type of thing, we don't really know, but they're allowed to go back and assess up to 50% of their individual assessment to policyholders. If it's over $2 billion, then they're allowed to go back and assess 100% of that amount. What we've seen in the past is assessments that have come through from different insurance companies, and they're spread out over 30 years. So when we see an assessment, it might be 59 cents, right, on their monthly
So you
bill.
don't think it's going to be a lot?
I can't really guess at this point what it's going to look like because the numbers are still coming in. I've seen estimates in damage anywhere from $40 billion to $120 billion. How much of that the Fair Plan is going to have for on their book of business is hard to tell. They're saying somewhere around 6 or 7 billion. It's probably going to be a little bit more than that. So we know there's going to be some type of an assessment likely, but how that will trickle down and how that would be approved by the Department of Insurance to potentially assess consumers on their policies later, it's too early, and we'd be looking at several years before that would even come to fruition.
So, in terms of your customers, you have almost about 100 people that have lost their home entirely, right? Can
Yes.
you tell us how many of your customers have been impacted?
Well, if I take how many people have been evacuated, we're in we're in thousands. If we're looking at how many people have actually lost their home entirely, meaning there was a home there and now there's not, we're a little over 100. I think 104 at last count. On top of that, we have a large number of clients that had to evacuate and their home has damage, but it's not completely damaged. There's smoke damage. There's damage from the fire department's work in the area. There's ash. There's smoke. All sorts of things. It's actually one of the more complicated claims to handle is a loss like that than a total loss. A total loss, pretty easy. You go out, you look, no house. When there's damage to a house, but it's smoke damage and the windows might have melted from the heat and you have chemical exposure, that's a little more complicated for the claims folks to deal with. So if you add all of that up, we're probably going to be close to 200 or 300 people that have some type of fire-related claim.
And how is the payments? Are they getting paid based on the value of the home or the replacement cost? You said $2 million, $3 million wires coming through. Where does that valuation come from?
Well,
and is it enough for the people that are...
Well, the policies all dictate how much they're going to pay. And all insurance policies are based on rebuilding the property, not the market value. So you might have something, obviously, in the Palisades, for example, that's very expensive market-wise. It might be $8 million to buy it, but the house is small. It might only cost $2.5 million to rebuild it, right? So when they purchase an insurance policy, if they purchase coverage that's sufficient to rebuild the house, then they'll have sufficient coverage on their insurance policy to get reimbursed and to have the home rebuilt. What we might see, unfortunately, is over time, and it's human nature, people sometimes like to save money, squeeze a little here, cut off a little bit there, and they would lower coverage. Who thought that the Palisades was going to have a loss like this, where the city is basically decimated? So I think the people that are going to potentially not have enough money to rebuild will be primarily people either that didn't carry insurance, and we can talk about that, or people that have over time lowered their coverage to below what the replacement value might have been. And fortunately, any gap that's there, they do have other alternatives they can go to. They can go to FEMA for assistance. They can also go to the Small Business Administration, the SBA, which are offering low interest loans to try and make up that gap as well.
And how much does FEMA help?
Depending on if it's a residential home, a commercial home, or a nonprofit, I believe they'll give up to $40,000 or $80,000 initially for residents. For businesses, I believe it's $2 million, and nonprofits it might be $3 million. I also suspect because these values are so high, this is not what we're used to seeing when there's. It's crazy to say used to seeing when there's a wildfire, that they just keep happening, but this is not what's been seen in the past. So I suspect that SBA might actually be making some changes at some point because they simply don't have enough for $2 million to be enough to help someone that has a $7 million gap between the amount of insurance they purchased and what it's going to cost to rebuild. The real problem is now what it costs to rebuild a house today could be 4 times more than it was 2 weeks ago, because when it's just your house, the cost will be what it will be. But when it's the entire area, the contractors are in more demand, the costs of labor go up, the costs of construction go sky high. But the policies don't change. The policies are whatever you purchased. So I think we're going to see gaps between what would normally have been expected to be the cost to rebuild and this increased cost based on the availability and the scarcity.
And what about the people that have mortgages? How does that work? Because they don't really own the home, and if the home is gone. Right.
Well, people that have a mortgage, what will happen is, we know that, for just an update, when you purchase a home, assuming you don't just write a check for it, I suppose some people do, but most of us, we buy a home, we put some money down, and then we go to a bank and we say, I need more money. And as collateral, in case, so you know that you're going to get paid back, you have rights to this property. Well, the banks say, okay, that's fine, but we want to insure that collateral. We want to be sure that we keep that safe. So they will be sure that you have an insurance policy for fire coverage. So when people have a fire loss, the money that's going to come in may or may not, it depends on the company, write the check directly to you and the bank to be sure that it's going toward rebuilding the house. Sometimes it might go directly to the consumer. Interestingly enough, the concern is banks are saying, we're afraid that people are not going to rebuild. They're afraid it's going to be like it was after the Northridge earthquake, where so many people didn't have earthquake insurance, they were just walking away from their loans. They would say, I can't rebuild, and the bank was stuck with an outstanding loan. What's happening now, people have insurance, but they might not want to wait.
Because they have to take it when they have a mortgage, right?
Exactly.
They have to have insurance.
But you can't mandate they have earthquake insurance. So back when the big earthquake happened, a lot of people didn't have coverage. Most people will have fire insurance, but they might not want to wait. We could be looking at literally 2, 5, 6, 7 years before all of these homes actually get rebuilt. And that's a long, long time. Some people might just decide that they don't want to do that. They just want to see what other options they have to be able to cash out, pay off their loan, and maybe move somewhere else.
So in most scenarios, people will get the money themselves and then they have to pay back the mortgage, right?
Correct. The obligation is on the people that take out the loan, right? So if you owe money to a bank and the insurance company pays you, you can be sure the bank's going to come to you and say, well, you have to keep paying your mortgage. People might decide to take the money, go do something entirely different, but just keep paying their monthly mortgage. That's a possibility. I don't know how long the banks might allow that, because don't forget their collateral is gone now. They have nothing to be able to protect themselves if the person just decides to stop paying. So it'll be interesting to see how that happens. But I was speaking with some people over actually at Wells Fargo not too long ago, and they were saying that their big concern right now is people that don't want to wait to rebuild, and they want to just move somewhere else, or they just don't want to take the time and the stress to be in that area anymore. What's going to happen with those costs to rebuild, and what's going to happen to the money from the insurance companies, and how does it get to them?
Possible for people to actually go buy something else with the cash they get from the insurance and then actually transfer the mortgage there?
It's a great question, and the answer is yes. What happens is if they have a replacement cost policy in California, they have 3 options. They can use the money to rebuild the home right where it is, mortgage stays put. They can purchase another home somewhere else, and the mortgage will go over to that property. Or they can build a house somewhere else, and the mortgage will go on that house as well. So the bank's going to follow the property, assuming that it's rebuilt. If somebody decides they don't want to buy something else, they don't want to rebuild, then it's possible they're going to get what's called an actual cash value settlement, which is going to be significantly less than the policy limits are, because the policy is designed to rebuild, right? The idea with insurance is to put you back to where you were, not just put money in the bank, right? So the policy has provisions to prevent people from just pocketing money and not rebuilding, and that might not be enough to pay off some of these mortgages.
In terms of insurance prices in California, where do you think they're headed? Because this is a major disaster and somehow we have to pay for it, I guess.
Somebody has to pay for it, right? And what's happening over the years, we've seen costs of construction go up. Costs of repair for vehicles goes up as well for automobiles. We see these prices, they keep going up. A lot of it's been a factor of inflation. What doesn't cost more money now? You go to the sandwich shop, and I can't believe how much money it costs to just buy a sandwich, right? Everything is more expensive, and insurance policies are buying all of those things, right? When people are out of their home now because of the fires, they're paying these higher rates for food for people to be able to eat. They're paying the higher hotel rates. So all of these increased costs that we're seeing started out, at least in some part, because everything was costing more money because of inflation. However, in California, we're so heavily regulated that the industry has been squeezed and squeezed and squeezed, where people that are in areas that are less likely to burn are paying more than they should because they're subsidizing homes that are in the higher brush areas. And people have been okay with that because the rates have been relatively comfortable. But now, because we're seeing so many of these wildfires, we're seeing fires not to this extent, but every 2 to 3 years. These types of events are what are called 250-year events. They're supposed to be happening every 250 years. That's how the insurance companies price them in their models. Now that they're happening every few years, rates have started to go up, 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 up. What we're going to see, I believe, is areas that are a higher fire risk are going to start paying significantly more for their fire insurance, and the people that are in areas that are less likely to burn are going to have a lot more competition with insurance companies, because that's where they're going to want to write. Those are the sweet spots where they're less likely to have some type of a major catastrophe. And when you have lots of companies that want to write in one area, competition will lower those prices. So I think we're just going to see the leveling start to shift. So you're going to be paying a lot more if you're in a higher risk area and less in an area that's not.
If you like California Insider and you like to know what's going on in California, make sure to check out Epoch Times. This is a newspaper that started by a group of Chinese Americans because of human rights abuses in China, and now is starting to grow here. Make sure to go to the Epoch Times website and check out the California section, where you can get a lot of fresh perspectives on what's going on in California. Now let's go back to the interview. And there was a number of homes that they lost their insurance. Did you have any customers that this happened to?
Well, a lot of companies were non-renewing. And non-renewing means you're going to have a period of time to find other insurance. We had a lot of people that were reaching out to us that were being non-renewed by, for example, State Farm. And we would try and find other companies that would accept their location, and we would write the policy. And as a last resort, we could also offer them fire coverage through the California Fair Plan. So anyone that at least contacted us, we had some options to give them so they wouldn't go uninsured. Unfortunately, some people just realized that either it's just not worth to spend the money. Remember, Fair Plan's not cheap. It's not a discount policy. It's discount coverage, unfortunately, but it's not a discount price. So a lot of people might have decided that they just didn't want to have that. And they would say, better off to just not carry insurance, or what we like to call self-insuring. What's interesting is if they have a mortgage, because we talked about that, right? The bank says you have to have insurance. If those people had a mortgage, then what the bank does is what puts on what's called forced insurance. The problem with forced insurance is it doesn't rebuild the home. All it does is pay off the mortgage.
So it's just covering the loan.
It's just protection for the bank. You're paying for it. The bank adds it right onto your payment and the money that you owe them. But all it does is it's a separate policy they take out that will repay them the amount of money you owe them. But it won't rebuild the house. So now you end up without a house, at least no mortgage, but no house and no ability to rebuild it. So we had a lot of people that were coming to us from other companies that were looking to find other coverage. And fortunately, we were able to always have something to offer them. Like I said, at worst, we could offer them just fire insurance with the Fair Plan.
So you said they were very expensive. How much? Can you give us some ideas of the ranges?
Sure. If you're looking to compare it with a regular homeowner's policy, right? And a standard homeowner's policy will cover fire, water damage, liability, theft, all sorts of things. And Fair Plan is just fire. Right? So it's significantly less comprehensive in what it will cover. If you had a policy that would cover everything, like we were discussing, for maybe $3,000 or $4,000 a year, the Fair Plan might be $8,000, $10,000, $12,000 for just that fire portion. So you can see how that starts to add up when people are saying, well, I was with State Farm, I was only paying a few $1,000s, and now I'm getting prices from Fair Plan for $10,000, $15,000 for just fire. They had some decisions to make, tough decisions. And unfortunately, I'm afraid, I don't have anything other than anecdotal at this point, that some of them might have decided to just forego insurance and now they're going to have to find another way.
And this Fair Plan idea, the model, it seems like the insurance companies are pushing the riskiest homes into the Fair Plan, but then eventually either the insurance companies or policymakers have to pay for the losses, right?
You're spot on. What, do you do this for a living? That's exactly the way it works. Fair Plan is an organization that is funded entirely by insurance companies. It's not the state of California. There's no tax money there at all. It's an organization that you have to participate in. The carriers don't like it, of course, because they have to put money in and they have to pay for claims. They'll also pay in the event, not with Fair Plan, but another organization, if a company goes bankrupt, all of the other carriers have to chip in to pay the claims. There's an organization, it's called CIGA, it's the California Insurance Guarantee Association. It's just a footnote, but the carriers, they're always bailing out somewhere, right? They're bailing out a company. If they don't pay, everyone else has to chip in. If there's a high fire risk area and it goes with the Fair Plan, the insurance carriers are paying. So you're right, to your point. You might come to them and say, I want you to insure my home. And they would say, well, that's too high risk for fire. You'll have to go somewhere else. They'll check elsewhere. They end up going to the Fair Plan, which is just going to them anyway. The difference is that instead of taking that entire risk, they're taking a percentage of that risk because the rest of it is spread with every other carrier that's admitted in California. So they're taking the risk, but they're taking on a percentage versus the entire risk.
So not one carrier taking all of the risk.
Exactly.
Is it because the prices are regulated in California? They can't raise the price, and then when they go to the Fair Plan, they can raise it a lot more.
Well, a little bit of both. Because there's such heavy regulation in California, the market's not fair. I mean, that's really the easiest way to put it. That's what we were talking about a little bit earlier, is because they can't do certain things, they can't differentiate so much between high brush, no brush, right? Everything is a little bit more balanced in between, so everyone ends up paying more. What's the saying? It's what high tide raises all ships. Right? I mean, if they have to cover the high exposure areas, then everyone's going to end up paying more to offset the cost. Like you said earlier, somebody has to pay for it. But as far as what's going to happen, FairPlan actually has to get permission from the Department of Insurance in order to raise their rates as well. The last time they went to the Department of Insurance to raise their rate, they claimed to stay solvent, they needed about 39%.
Wow.
And the Department of Insurance gave them, I think, 13 or 14, which the news, of course, said 14% increase, which is horrible, but it's not what they needed. They needed a lot more, and that's part of why we're seeing this shortage right now in general. The problem is that it's expensive to insure in these areas that have high risk for fire, and we're seeing that now. So I don't know what the long-term solution is going to be, but somehow we're going to have to come to grips with the fact that if you're going to live in an area that has this potential, it is going to cost more than it used to insure it. And we're not going to be able to shuffle the burden off to people that are in other less likely to burn areas to offset the price.
Now, there's two categories of insurance companies. For people, there's some that are admitted and there's some that are non-admitted. And some of the admitted ones were walking out of the state, right? They were not renewing. Can you explain to us what's the difference?
Sure. When a carrier is admitted in the state of California, they are basically saying we will follow the rules that the Department of Insurance gives us. We're going to protect the other insurance companies, like we said. We'll participate in the FAIR plan. We'll let you decide what we can charge, what we can't. They basically say we'll follow the guidelines. Now, a company might decide, I don't want to do that. For example, Lloyd's of London. We all know about Lloyd's of London. That's a non-admitted company in the state of California. They're not licensed to do business here. They can, but they're not licensed. They're not part of that pool in general. So it used to be, if you had to go to a non-admitted company, there was definitely a problem, right? You had some type of claim history, or the risk was just so extreme, you could only find coverage with a non-admitted company. But over time, because the admitted market was shrinking so quickly, companies kept leaving the state, non-renewing policies. Other companies that were not licensed in California said, well, we see the opportunity to write some business here. And since they're not admitted, they can charge whatever they want. So we saw a lot of non-admitted companies coming in, writing business, charging unbelievably high premium, and people didn't really have a choice. The important thing is not so much are they admitted or non-admitted, it's what does their financials look like, right? Do they have
Do they have the money to pay?
Right. There's nothing intrinsically wrong with a company not being admitted as long as they're a substantial company and they have the ability to pay the claims. There are plenty of companies that are admitted in California and they don't have a lot of money. It would surprise people to learn how little they actually have, but they're admitted. So people have this feeling that they're safer with them regardless of the fact that a non-admitted company might have 10 times the money in the bank that they do.
Our sponsor today is Shenyun. There's been some negative press on Shenyun recently. Shenyun's mission is to revive ancient and traditional Chinese culture. Shenyun Performance started by a group of Falun Gong practitioners in New York. Falun Gong is a spiritual and religious group which believes in living by truth, compassion, and tolerance, putting others first. The Chinese Communist Party, CCP, has been persecuting it since July of 1999 in China. Since Shenyun started, CCP has been targeting it in the US and across the globe by playing different kinds of schemes to cancel the shows or impact the performance. The current negative reporting originated from some Chinese social media accounts. And we know that CCP is given a new directive to go after Shenyun and Falun Gong in the US by turning the public opinion against them. If you hear something negative on Shenyun, make sure to do your own research and your own due diligence. Despite all of CCP's campaigns against Shenyun, the show has managed to grow significantly across the world. I highly recommend you go see it. I've been going to it for the last 14 years as they change the performances every year. They're coming back to California. Make sure you go see it. must be very stressful for you. Like you got evacuated yourself, right? And for the last few years, it's been hard in the insurance space. Can you tell us what's happening with you and your firm?
Thank you. Yeah, it's been a challenge. Let's put it that way. I've been doing this for 30 years. Now you're supposed to say that I must have been in kindergarten when I started or something like that.
You started.
There you go. So, I mean, I've been doing this for a long time. And the last 5 years, for sure, has been the most challenging. Because my job is to go to all the insurance companies and find the best match for our customer, right? You come to me and you say, find me the best coverage, find me options. And I say, well, we can go with company A, company B, company C. We decide based on price and coverage what works, and we go from there. All of a sudden, I don't have A, B, and C. I don't have A and B. I may not even have A all the time. A says, well, maybe I'll give you one policy a week instead of 20 or 30 that you normally are used to providing for people. So that's been very stressful because we can't do our job. And we're forced to have to do things like tell people, well, the only option we can find is with a non-admitted company, and it's $31,000. It's mind-blowing because you could never imagine that a company would charge that, but when there's no other option, people have to actually make that decision. Do I want to spend that money or not? Now, most recently with this fire, it's made things, as you can imagine, that much more difficult because now that one company that might have had some interest in writing, of course, everyone has stopped writing new business right now entirely. The fires are not even contained completely. So they're waiting for that to be done. And we're going to have to see how that starts to pan out. So all we're doing right now is working to be sure that our clients are speaking to the adjusters. The adjusters are doing the right thing. They're getting them their money right away. We're really just in that assist mode versus in that sales mode.
For people that are concerned that they're worried that they might not get the value of their homes, what are your thoughts?
As long as they have a good policy from a reputable company, then they shouldn't be concerned. The only people that should be concerned are if they either underinsured their property, right? Maybe they know, I mean, people, they have the conversations, they make the decisions and they say, well, I need to save money. So they make the decision to have less coverage. Maybe sometimes they'll just lower personal property to save money, or they'll say, I have another location I can move. I don't need loss of use coverage. They'll do things to try and save money. And now maybe they're unfortunately not happy about having done that. But as long as you have insurance with a reputable company, you shouldn't be concerned. The only time to be worried is if you're with a company maybe that you haven't heard of and you're paying a lot of money. Those are the carriers that you want to be careful of.
And now, do you think this event will impact the rest of California?
It's going to impact not only California, but the rest of the country and the world, actually, because reinsurance companies, which are the companies that insurance companies work with, right? So you might give me $1,000 for your insurance, and I take 500 of it, and I sell it to another insurance company, and we share if there's a claim.
So you share the risk.
We share the risk, right? That's a reinsurance company. There's a lot of reinsurance in California. Those are international companies. All of those companies all of a sudden are going to be writing some very large checks. So that's going to impact the reinsurance cost worldwide. Everyone's going to be feeling that effect. Just like you might have heard in the past, people in California getting very angry that we're subsidizing the hurricanes, in the Southeast. It's not fair. Reinsurance is what they're actually talking about, whether they realize it or not, because when there are large losses like that, the costs of reinsurance go up for everybody everywhere on the planet. So we're definitely going to see rates changing pretty significantly. And I think the way it will finally pan out is you're going to be spending more money if you're in a higher risk area and less if you're in a lower risk area. But overall, everything is going to be more expensive than it was, let's say, 5 years ago.
And how big of a loss is this compared to other events that has happened? How big is it?
It's the biggest one. And at most recent count, I think they're saying the economic loss could be $500 billion.
$500 billion.
In economic loss. So that's the construction and the business loss and everything else.
GDP and all the activity.
I hate the expression unprecedented because it was used so much for so long, but it's truly unprecedented. We had a city wiped off the map. I mean, Pacific Palisades and the area on the Eaton fire as well. These were cities that were there that are just not there anymore. And the amount of cost to rebuild is always what we're talking about. But when you think about it, you're talking about businesses that are gone. You're talking about livelihoods, and that one business might employ 50 other people. All of those people are out of work. You can even, if you want, go down to the lowest level. People that had a home in the Palisades, for example, or anywhere that don't anymore, they might have had a housekeeper, a gardener, a pool man. I mean, all of these things spread out and are impacted by these fires.
Now, what was it like for you when you saw this amount of damage?
I think it happened over a period of days because I was so busy talking to clients and making sure that they don't be brave. That's one of my mantras, don't be brave. Don't be the one on the roof with a hose. It's not going to help. And it's dangerous. And at the same time, you might actually be in the way when the firefighters are coming, right? So we were so busy trying to tell people to evacuate, where they can go. Yes, you have coverage, go, go, go. I wasn't really paying attention to the actual amount of damage. And it happened very quickly. It was a matter of maybe 8 hours. It went from, oh, there's a bad fire to, oh my gosh, the Palisades no longer exists. And now there's this other fire that's burning in the valley. So I think it still hasn't even really hit me because we're still working around the clock, literally around the clock. We take shifts in the middle of the night to check emails, and we'll call people back. And I'll tell them, if you email me at 2 a.m. and you want to call back, be careful, you might just get it. But, we have to offer coverage, comfort together. Because it's not just a matter of telling people, yes, you have coverage. You have to be able to comfort them too, because there's a lot of emotions that go into this. You can't replace a lot of the stuff. You can build a house. You can't put back the things that were in it. You can't put back the childhood memories. You can't fix any of those things.
So you get back to people in the middle of the night?
Oh, absolutely. We literally have not stopped since January the 7th. We're on email, text, phone, around the clock. And everyone in the office has really been stepping up, I have to say. And they don't have to. We don't need everybody to be on call all the time, but everybody's volunteering. They want to be there to be able to take calls, respond to emails, text with clients, because we're the ones they can always get, right? The claims adjuster may or may not be available. I hate to say it, the California Fair Plan was closed on Martin Luther King Day. And with all respect, I feel like that Dr. Martin Luther King Jr. would be very unhappy to think that when people needed them the most, they were closed in his name. You don't close during a disaster like this when people are reaching out. So if they can't reach their adjuster, they know they can reach us. And we're there because I feel like that's the real value that we can offer for people. We can be there to be sure that they know they're not forgotten. We can follow up with the claims adjusters. We can be sure that things are in process.
So you've decided to go 24/7, get back to people. How did you learn to do that?
We just didn't turn the phones off and started responding to people. We didn't actually send anything out that says we're available around the clock. It just started happening that way. And I think we'll continue to do that until we have everyone at least situated somewhere where everyone's adjuster is in contact with them, right? Everyone has some place that they're living comfortably. They're not couch surfing between friends' houses, because that happens. People, even though we say you have coverage, you can go find a hotel, they might not want to do that until they actually have the money. They may not have the means to do that without the money. So until the adjuster gets back to them and sends the money to them, they might be staying with friends. And that's a very insecure feeling. So when they're texting at midnight and they're saying, do you have any idea when I might get that money? I'm absolutely going to always want to respond to that. Who else is going to respond to them at that point? My father, who started the agency with us many years ago, used to say that they buy insurance, all they get is the piece of paper, the insurance policy, and us. So we need to be good. And now all they get is a PDF and us. So we have to be even better.
Is there any misconceptions or rumors or things that are good? Because there's a lot of worry right now. Do you see something that you want to address to our audience?
I think everyone should realize that worrying and being scared is completely reasonable. If you weren't, there's probably something wrong. Being scared is what you should feel right now. But with regard to getting your insurance policy to pay, don't worry until you have a reason, and if you have a reason to, right? Don't listen to all the noise, because everyone loves to hate on the insurance carriers, and that's fine, I get it. That's the man, right? That's the big man. But unless you've had a problem or you're having an issue with your adjuster or the insurance company, don't rattle yourself prematurely. You really don't have to. Most people, like I said right now, the vast majority of people are having very positive experiences, relatively speaking. They're getting money quickly. And if you're having problems, call the company, call your agent or broker, ask for another adjuster, ask for a supervisor. There's things you can do if you're having problems. But in essence, don't start off assuming the worst, because so far the companies have not given us a reason to be that kind of concerned.
Karl Susman with Susman Insurance Agency. It was great to have you on California Insider.
Thank you so much.
Let us know your thoughts about this episode with Karl on home insurance. You can always reach out to me at siamak@californiainsider.com, or you can always leave comments. We always read all of your comments and emails. We'll see you next time.